And this session will actually be a panel discussion. So it'll be a panel discussion talking about how data empowerment as a concept and open banking are being embraced around the world, and how India's stance can inform global views on this very important subject. So the panel moderator for this chat will be Mr. Srinivas Jain, who is Executive Director and Head of Strategy at SBI Mutual Fund. So please put your hands together for Mr. Jain, who will be the moderator. I'll now invite the speakers to please join him on stage. We have Shri Chanchal Sarkar, who is an advisor to the Ministry of Finance on issues relating to G20, financial inclusion, and financial issues. Welcome, Mr. Sarkar. Please keep a round of applause running for all of our speakers. Penultimately, we have Mr. Anil Mahalaha, Chief Evangelist of Akoya, a leading open banking and open finance platform based in the USA. Please come up, sir. And finally, our last speaker is Dr. Bill Roberts, Honorary Fellow at the Cambridge Center for Alternative Finance and former head of the open banking of open banking for the United Kingdom's Competition and Markets Authority. Welcome, Dr. Roberts. Thank you. Mr. Jain, over to you.
Right. Good afternoon. I hope you can hear me. Right, thank you. Thank you, Abhimanyu, for that kind introduction of all the panelists. And I actually get to meet some of the panelists during the day, and we've shared some very interesting insight. But, you know, the whole day we've been listening to Account Aggregator, all the use cases, how this is kind of taken off. It reminds me of a Bill Gates quote 20 years ago. He said in 1993, I don't know if you remember this, Bill. He says, banking is important, bankers are not important, or banks are not important. Today with the open banking and the AA ecosystem, something like 20 years later, something of that sort is kind of happening. And it's very interesting to hear. So this session, we've planned to bring in the global expertise around what's happening around the global banking experience, especially with Dr. Roberts actually spearheading that in UK as part of his, I think he was the first person to talk about it. And now, of course, we will hear him talk more about from the UK experience. And UK has been known for the open banking. They've been the pioneers in the open banking experience. We also have Anil, and Anil comes from the so-called open markets, which is their experiments with the US and the open banking, especially with the private sector kind of a focus. The open banking is taken there in the US. And of course, Mr. Sarkar. Mr. Sarkar doesn't require introduction. He's, he works with the government, but more importantly, works on the inclusion piece, and more importantly on the DPI piece, and the experience that he brings from the G20 and the work that's happening on the DPI space, we'd like to explore more. But without further ado, I would start off with Dr. Roberts, and maybe if you can take some, your initial introduction about how did this come about, what's the UK's model, and what's the learning for India from the UK's model?
Okay, thanks very much. I think I had to start by just setting out what the problem was we were trying to fix in the UK, which wasn't an issue of financial inclusion. It was purely about competition. Because in the UK, we'd had a competition problem with retail banks for 20 years, which we'd been unable to solve. And the problem was essentially this, that we had persistent and severe concentration in the market. We had 4 big banks that had 85% of the personal current account share in the UK. We had poor service quality. Even on the bank's own surveys, they were offering pretty bad service, not just to consumers, but to small businesses as well. Small businesses were paying very high prices for their current account services. They're paying on a per transaction basis rather than a flat rate. They were getting a very poor deal on finance from their retail banks, as were consumers who were paying up to 40% interest on their overdrafts. But despite all that, people weren't switching banks. And it was statistically the case that in the UK, you're actually more likely to get divorced than you were to change your bank. This has been going on for 20 years and nobody had figured out a solution. And we had tools in our toolkit, conventional regulated tools, information remedies, structural remedies, but none of those tools seemed to be likely to work, which is why we turned to open banking, which was an idea. It wasn't our idea. Like all the best ideas, it was stolen from some other people. But we could see that could offer consumers and SMEs a lot of advantages. Some of the products we could see were sweeping services, which would take money out of your current account when you weren't using it and put it into an interest-bearing account automatically. And if you were overdrawn or going into overdraft, it would charge you less than your bank would charge you for that overdraft. Similarly, for SMEs, we could see the potential for seamless integration with some of the cloud accounting packages that are around, and better deals on finance. But we had a problem. We had powers, but we had some problems. First of all, the banks did not like this idea at all because they could see that inevitably it would hit their return on equity and could eventually push them into a position that some phone operators were, whereby all the interesting stuff that they used to make money out of now appeared as apps. So phone operators were making a lot of money on international calls and messaging, and then along came Facebook Messenger, WhatsApp, and Skype, and they could see the same thing happening with mobile apps in banking. So luckily, the CMA had power, legal powers, to force the banks to adopt open banking, which is what we did. The other two people to get around the table were consumers, and they needed to have a value exchange in prospect, otherwise they wouldn't join. They had to be reassured that their data was secure and that nobody could impersonate them and steal their identity or defraud payments from them. And finally, we had to get the fintechs involved. And what they wanted was a liability framework that favored them. They wanted free and continuous access to transaction data, which they're entitled to under EU law, the PSD2. We had to get all those three in place to make it work, which it took us longer to do than we thought it would, by a couple of years, but we did it. And now we're in a situation, the numbers mean nothing here. I was talking earlier on to colleagues here who said, well, one of the Indian banks has 250 million customers. So when I say that we're very pleased that 7 million UK consumers are now using open banking, it sounds small, but it's a reasonable percentage after this time. More compelling is the uptake amongst SMEs. It's estimated that getting off half of small businesses in the UK now use open banking on a monthly basis. So it's looking good so far. We're not at the end of the journey yet, but we've had, I think, a reasonably good start. I'll stop there, talk about any of that later on if you want.
Yeah, thank you so much, Bill. It was not 250 million, it was 450 million customers, Bill. That's part of our group, so I could say that with confidence. Thanks, Anil. Anil, I think the US market has kind of taken a completely different approach to open banking. It's more what we call a market-driven approach to open banking. But in the recent time, you have this Consumer Financial Protection Bureau, CPFP, coming out with their requirement for data transparency, data protection. And that's kind of changing the approach to the consumer rights and their access to that, their data. So what's happening there? What is the initial work that you guys are doing in the US markets?
Yeah, sure. So in the US, the open banking, so to speak, has been going on for a while, but it's behind closed doors. It's the screen scraping that has been going on. So there was no consent involved. Customers would get their username and passwords to the data aggregators, and they would scrape the data and store it. But after the pandemic and during the pandemic, there's an explosion of fintechs in the US. And the government started to realize the enormity of the problem, especially, it is if you look at it, millions of customers' username passwords stored in databases of unregulated entities, and it is kind of a national security threat as far as the US is concerned. So CFPB, which is the Consumer Financial Protection Bureau, started looking into it. There are other House Financial Services Committee started looking into it. There were other regulators started looking into open banking. And the banks, meanwhile, were getting scraped. The traffic to the banks were upwards of 40-50% of traffic was bot traffic. So the banks got together, and I was working at Fidelity Investments at that time, and we started writing public APIs for Fidelity to provide data. And so the banks, Bank of America, JP Morgan, Wells Fargo, PNC, some of the largest banks got together and bought Akoya from Fidelity and launched it as an API-only platform to provide data. So when we were launched, there were already multiple aggregators. So the definition of data aggregator in the US is different from the definition of data aggregator up here. In the US, the data aggregator actually stores the data. It doesn't store consent at all. The consent is with what you call the FIP.
So it's the other way around.
Yeah, it's the other way around.
The aggregator doesn't store the data, but stores the consent.
Consent, yeah.
Right.
So it is a different model. So the model in the US is the financial institutions are called data providers. What is FIP up here? In the middle, what you call a data aggregator or an account aggregator in the US is called data aggregator.
Right.
And then it's all the fintechs. It's not FIUs, they're not regulated, the aggregator is not regulated, the fintech is not regulated. So it's an unregulated market. It's a market-driven approach,
right.
As opposed to a regulatory-driven approach. So there are pros and cons, we can get into it, but that's really what the environment is.
And just a follow-up on that quickly. So there is an incentive mechanism built for all of the ecosystem to survive. I mean, data aggregator gets paid, the end user gets paid as part of the process?
Yeah, the incentive mechanism is called the green dollar. That's
Right.
the incentive mechanism. And everybody's making money off of that. Now the regulators are stepping in, the CFPB, like you were talking about, regulators stepping in because the data is being monetized in the US. So the consumer isn't really giving consent. Now they are through API-based data access, so they are giving consent. So what the CFPB is trying to do is limit the use of data, which is something that you guys will have to think about up here when the FIUs and TSPs have the data, that they're using it for the use case as opposed to using it for other purposes that the user never consented to.
Yeah, that's very interesting. It's another fork of what was happening in UK. Mr. Sarkar, how does the open banking or the account aggregator platform ecosystem that we have in India, how does that align with the GPFI objective, the G20 objectives, and what impact do you see in terms of financial inclusion that these open banking and AA platform kind of bring to the table?
Thank you. Thank you very much. I think I should elaborate a little bit. Maybe this is G20, GPFI's Global Partnership for Financial Inclusion.
Right. So my bad. I should have expanded. Right.
Okay,
Please.
Okay.
Yeah.
So let me spend 1 minute on these basics, like the financial inclusion, and why it is so important that still the huge number of people, 1.4 billion people, are still outside of the formal banking sector worldwide. There is a huge amount of finance gap in the SME sector. As per studies, this $7 trillion is the gap, finance gap. Mm-hmm. And worldwide, the SME sector is the huge provider of employment. In some cases, some countries, it's more than 80% employed. So therefore, there is a need to have the financial inclusion, which would improve the inclusivity and growth and development through employment generation, higher income. Right. Now, the G20 is a group very much recognizes the importance of financial inclusion, and within the G20, under this current India presidency, one of the agenda and flagship agenda is to enhance and advance financial inclusion through digital public infrastructures.
Right.
Now, there is a 3 foundational DPIs are there, which are, one is digital identity, another one is the payment system, and third one is consent-based data, which is account aggregator figures in here.
Right.
So one of the basic and most important pillar is the account aggregator. So where we are trying to work and have an ecosystem approach where these 3 foundational digital public infrastructure works, and the account aggregator instead of, and we have found that huge number of entities, SMEs, are outside the formal financial sector because there is a transaction cost is very high. The interest rate and the other barriers, traditional barriers, are very high. The collateral systems. So account aggregators has the huge potential, and this provides the opportunity of cash flow based lending and credit, which can solve this problem in a major way. So therefore, and the G20 as a forum is working this advancing financial inclusion, and therefore bringing in this DPI-led approach and account aggregator, and that would help not only just one country, but the G20 countries and beyond G20 countries that can resolve and solve many of these problems, because these can also work like other pillars like digital identity and payments at its scale. So that can be enhanced and be used for inclusivity and growth, which is the ultimate objective.
No, it's fantastic to hear that it's not just something that we are talking here. It's been talked at a G20 level across 20 large economies. Back to you, Dr. Roberts. And you did talk about how this whole thing came about, the open banking. But in 2016, when this was built up, and I used to read a lot of these reports talking about massive economic benefit, big growth. I know in SME's case, you've talked about significant growth. But why is the offtake a little slow compared to what was projected? What are the actual challenges in the UK open banking market?
Well, first of all, the build was slower than we thought it was going to be. We commenced the project in December 2016.
Right.
The legislation to make it all happen didn't go through till 2017. And then the banks basically asked for more time. One of the big problems we had, and it's very different here, one of the big problems that we had was that there wasn't much of a foundation to build on for 3 reasons. First reason was that the consolidation in the retail banking market had come across because of mergers. Because, as I said, if people don't switch banks, you can't lure customers from one bank to yours in the normal competitive process. If you want to get more customers, because people are more likely to get divorced and they ought to switch banks, you have to buy another bank.
Okay.
And that process went on for 20 years. And normally, in good management, if you acquire another bank or another company, you would integrate your systems. That didn't happen terribly well. And there are a lot of cases where the labels, the facades changed on the bank branches, but the basic banking platforms they were using was kind of stitched together. Somebody told me that you still see, a few years ago, ads for programmers in COBOL or Fortran, many of us of which have forgotten that those existed.
Yeah.
So there were problems in building the new stuff on some fairly shaky foundations. The second problem was that some of the infrastructure that you benefit from here we didn't have. So in the UK, we did not have an electronic national ID system. You do. In the UK, we did not have a much-used account-to-account payment system. It was all cards or checks. Yeah, some other jurisdictions have are very advanced in that respect. We weren't, so that took longer. I think in terms of why wasn't it quicker or why hasn't it happened more quickly, I think it's mainly to do with the products that have come online so far and the environment in which they're operating. So one of the benefits I said earlier on was that people could get cheaper credit.
Okay.
Now, in a zero or nearly negative interest rate environment, that doesn't matter a huge amount.
True.
It gets more important as interest rates start to go up, which they have been over the last couple of years. But what did surprise us, and while everyone was kind of looking over there waiting for consumers to start adopting, what was going on behind us was this massive take-up of open banking tools by SMEs.
Right.
And then by the government. And I do remember having a conversation with Amazon when I was trying to persuade a big user to adopt open banking payments. And then, unbeknownst to me, I realized that the Internal Revenue Service in the UK had adopted it. So suddenly, the Internal Revenue Service, which had been taking, I think, £12 billion a year via credit cards for collecting tax, suddenly switched
To open banking.
to open banking payments, which meant A, they paid less, and B, they got the money quicker, going straight into their bank account. So while everyone, as I say, was looking at the game over here, the consumer take-up, where there weren't no killer applications yet, credit not terribly interesting because interest rates were low, behind us, massive uptake of open banking by SMEs. And that pattern has been replicated around the world.
Right.
People have been surprised and delighted by the take-up of SMEs of open banking.
It's also interesting that you tell me now it's almost 50% of the today open credit.
Something like that. 50%, roughly 50% of SMEs in the UK are monthly users of open banking, either, or in a lot of cases, because of their use of cloud accounting systems like Xero, Sage, QuickBooks, which integrate seamlessly and save them money. They can also access much more easily finance platforms, which will very quickly use their transaction data to figure out their eligibility for various lenders, and will even analyze the transaction data to tell them, well, maybe you don't need a cash loan, maybe what you need is invoice financing, your cash flow seems to go up and down, and so forth. So that's been a very similar pattern everywhere, that everyone wants to get money into their small businesses because that's what makes your economy grow. And that definitely does seem to be working in the UK and these other jurisdictions.
Interesting, because it's not something that we talk too much in India, but SME is a big pool, and I am hoping that we will have interesting solution on AA also to address that. Except that today we are a very end-to-end solution, FIU, FIP kind of a solution. Maybe there is need for us to look at all those tech hooks that needs to come. Anil, I think you did touch upon the design of the US market. But again, it has its own set of challenge, and now we have regulations coming up. What is the issue with the US markets today for adopting open banking head on compared to, let's say, UK or now in India with AA?
Well, I think it's the it's the mindset of the banks, right? Where it took them a long time to understand that the data belongs to the consumer, not to them. It took them a long time, and still is, taking, more time to understand the benefit of open banking, not the FIP. So I'll use the India terms, right? So the FIPs don't realize the benefit of open banking. The FIPs in the US were coming to open banking, kicking and screaming, right? And so that was one of the impediments.
Right.
The other one was the consumers really didn't care. In the US, if you lose your money, the bank will make you whole, right? If somebody, makes a purchase, I have a horror story from here several years back, which I will keep to myself. But if somebody charges your credit card and you didn't really charge it, or somebody withdraws money from your ATM machine and you didn't really take it, you go to the bank and the bank is no questions asked, they'll give you the money back, right? And so the consumers really didn't care, they didn't have the incentive, right? So, and meanwhile, the data aggregators had made a business out of the data. So, the data is what I say in many platforms, that data is king, right? You have to understand the power of data. Data is information and can be hugely leveraged. The amount of money you can make if you have good data is just tremendous. So there was nobody motivated to do it.
Right.
Right, and so like I said, after the pandemic, when most people couldn't go to a bank, which they didn't used to go anyway, right, started using the fintechs to do a lot of things sitting at home. And so that's when the Financial Protection Bureau started looking into it, and other regulators started looking into it, and the banks started looking into it, and realized the amount of risk that they are sitting on in terms of username passwords being out there. A lot of these banks don't have OTPs in place. Now they have OTPs in place, or second-factor, two-factor authentication in place. So now the CFPB is coming out with regulations, or is talking about regulations. By the time we actually see it, probably be the end of this year when you see it. But they still have a problem. There are like 9,000 banks in the US. It's not like 2 banks or 4 banks, but thousands of banks in the US. And they're all sizes. So if you implement all of a sudden, if you go and say, okay, account aggregator is the new model, everybody implemented, well, fine, who's going to pay for it?
Right.
Right? Why would the bank spend money standing up the AA infrastructure, or the APIs the very least, and throttling it and doing management? And the consent is managed by the bank, so you have to do not only onboarding of the clients, or it's called the dynamic client registration, but you also have to do consent management, wherein you're not getting any money, right? So the regulators realize that there's no incentive on one side. There's this huge amount of data lakes that have been created. Consumers are not aware. So they're coming in with regulations on all fronts, where the FIPs will have to implement the APIs. And the other thing they're learning is that just implementing API doesn't make you open banking, right? You have to actually make the API performant. Right. You can say, I'm open banking, you stand up the API, and then it takes 2 seconds, 3 seconds to get your data out. There's easy ways to slow it down, right? Or you throttle it down to where it's like getting 5 TPS opposed to 50 TPS, right? So the regulators are coming out with the regulations in that space, where the banks have to, make the APIs performant and also provide all the data that is required for your use case. And the person who knows the best is the fintech who's doing the innovation and
Right.
is going to provide the service to the consumer. They know what data they need, not the bank who knows what data they need. In the middle, for the data aggregators, or up here, I'm not sure what you'd call it, FIU maybe, right? There are regulations coming in terms of how long you can store the data, what you can do with the data. There's a concept of de-identifying the data, so you can remove PII from the data. You can keep the data, and that's where a lot of innovation happens on the data. And then on the data recipient side, again, full disclosure requirements are coming. You have to tell the consumer what you're going to do with their data. They have to agree to that. That consent has to be transferred to the bank through the data access platform, which is the data aggregators. The bank registers that. And when the fintech goes to the bank to get the data, they apply those rules,
Right.
which is in terms of a rich authorization request. They apply those rules and then give the data. And so there's regulations all over the place. Screen scraping in the US will still continue. It is not going to go away for 2 reasons. One is a majority of these banks are credit unions and small banks, like 2 branches, 3 branch banks. And for them to stand up APIs is going to be cost prohibitive and probably shut the bank down in order to meet that regulation compliance. So screen scraping is still going to go on. And then the other reason is, if the big banks, owners of Akoya, right, they start to play, games in terms of amount of data or quality of data or speed of data, then the threat for screen scraping is there. And I can talk about the threat for screen scraping later on, but
Sure.
That's the landscape of the US.
So at this point of time, it's not regulated. Data aggregators are not regulated.
No.
And they can do whatever they want to do with the
Right.
data.
Yeah.
Interesting. And it's all going to change with CPFP coming with their...
Yeah, the Consumer Financial Protection Bureau, CFPB, it is going to change. So end of this year, they'll come out with the rules. It's been going on for 2-3 years.
Right.
There's a lot of public feedback you have to take. There's a lot of agreement you have to, CFPB cannot just come up with a rule because it'll get challenged and it'll be dragged on in the courts. So in 2024, when the implementation will start.
Yeah, it's good, but we have it good here in India. We have the whole infrastructure ready, and that's a question that I want to ask Mr. Sarkar. I know we have this new eco-structure. It's up and running. But what challenges do you think that we have for AA with the way it's implemented and the way it can be implemented with some of the learnings from UK, US, and maybe other markets that you cover from G20 perspective?
Okay. So what I understand is essentially these are market-based model in the US and the UK. And whereas the account aggregator that we are pursuing, and then we're trying to see at least from the lens of the DPI, if I see that the digital public infrastructure, since it's one of the major pillar of this DPI, and by definition and characteristics in the context of DPI, they are very well regulated. They are in the ecosystem approach, and the regulations are such that it has a very fine combination of private, public, regulator versus innovators. Like they would be. On the other hand, the challenge on the DPI model on the account aggregators in India, that's in providing incentivization. Incentive. Right. What would be the incentive that why big banks will come on board? Right. Similarly, on the other hand, they're in their model, the US and the UK model that's more open and market driven, that has enough incentive. But that has also some drawbacks. There would be transaction cost. Since there will be a number of players, and then if you want to have all the information, then you need to have additional time and task to gather information. Then there is a question of trust. Right. Trust whether this private market can generate adequate trust. Right. And then vis-a-vis the other government back. And again, like so for some other areas where this something is called the economy needs some amount of hand-holding, where is it the market that can actually do that hand-holding ultimately, that part also remains to be seen. So therefore, there are positives and negatives. So that overall, I think it's for a beginners or some calibrated approach would be slightly more warranted, I feel.
It's very interesting, Mr. Sarkar. You touched upon the trust and the, because of the way it's built versus a DPI kind of setup. So, back to you, Bill. I think UK. How is UK market addressing the whole security and fraud prevention concerns that of late there's some debate in the UK market, and how are you mitigating that piece?
I think the initial framework that was put in is pretty good. That the standards for security, encryption, and so forth, the international standards that everyone's adopting. So I think that's okay. Mm-hmm. I think the issues arise in the case of particularly push payment scams in the UK. That's basically persuading a consumer to send money to somebody else by trickery. So it's correctly authorized, but the person being paid, the payee, isn't the right person. It's been diverted to some other account. That's probably the single biggest issue. Right. Now, that's already covered by PSD2, and the UK legislation mirrors that now, such that there's strict liabilities on the bank. So if that happens, then under open banking, the bank should be strictly liable for that. There's more legislation going through now to safeguard that. But if there is a gap, I'd say it's probably not on the payment side. I'd say it's probably more on the account information sharing side. And in particular, I think there's an issue with the onward transmission of data. So you share your data with party A. For technical or other reasons, they may share it with party B, who may share it with party C. So we're talking about third, fourth, fifth parties that it's being shared with. I think the solution there is probably, and I don't think it's quite put into law yet, it's to set the liability on, just to say this is where it stops, on the regulated party, and say you must not, it's your liability if you pass it on to someone else who then misuses it. So the buck has to stop somewhere. But the other thing I'd say is that although the banks in the UK, some of the banks, have said publicly that they think that there are security issues with open banking, more so than with other payment systems, they haven't produced any evidence to show it. And every time we say, well, come on, where is the evidence to show that it's worse than other account-to-account payment methods? We haven't seen that evidence yet. But as I say, there's legislation going through Parliament now which will apply to all data sharing, not just in finance, which should finally close those loopholes.
Interesting. Back to you, Anil. I think Akoya has been playing a very significant role in the OpenAI, open banking, framework in the US, especially with marquee banks being your promoter. But then the Section 1033 puts a lot of regulatory pressure on you, and you did kind of touch upon it. So how are you navigating this new 1033 section, and what kind of regulatory compliances that you have to go through? And what challenges that you think you will be facing in coming days when you got to go through with this new provisions?
Right. Okay. So let me explain what 1033 is. Section 1033 is a section in the law that was written in the US in 2010 after the financial collapse, where a lot of these banks, when they collapsed, like the recent couple of banks that collapsed, they took the consumer's data down with it. So if you didn't print your statement or you didn't save your statement, you had no idea what your transactions were, what your money was, how much balance you had. So there was a legislation at that time to regulate the banks more strictly, and that was the Dodd-Frank Act. And as part of the Dodd-Frank Act, there was a section in the Act called 1033. There was 1032, 1031, 1032. So by the time it came to financial data sharing, the number was 1033. So that's where the 1033 section comes from.
Right.
And one of the things that was also created at the time was the Consumer Financial Protection Bureau, which was non-existent before that. And the Consumer Financial Protection Bureau was tasked to put regulations around 1033, and what that means is, it's very simply that the banks have to share the data with a third party if the consumer consented to it. So saying that the data belongs to the consumer, not to the bank. So CFPB then took that and then has now taken, since then, has now come up with regulations in the space. Akoya was created with that in mind already. So we knew, the pitfalls of the US banking system, the US data sharing, the account aggregation and all of that. So we built a pass-through system, not very dissimilar to what the account aggregators are up here, where they manage consent and then they, manage the connectivity and they pass the data through. In the US, the consent is managed at the bank, so it's not a centralized consent, it's distributed consent. CFPB has no say on that. The banks are going to manage consent. But the CFPB, like I said, you have to have APIs, you have to have the APIs performant, you have to have, a reason to ask the data that you're asking for from the bank. If the consumer is agreeing to using your service, that does not give you free reign on all the data and every data they have, which is what was going on in the US when they were screen scraping. They would screen scrape everything, your beneficiaries, your date of birth, your PII, statements, everything that they could get their hands on. And they're like, okay, fine, now we have this data. The fintech is only asking for a small percentage of the data, which is fine, you take it. Now what do we do with this data that we are sitting on? And they figure it out. All the machine learning runs on it, all the analytics runs on it, all the credit card offers that go out run on it, right? So what the CFPB is now saying, if the consumer agrees to you doing what you're doing, keep doing it.
Okay.
But if the consumer does not agree to it, stop doing it.
Interesting.
So the power is going back more to the consumer and what happens to the data, who they give consent to, and the fact that they can get the data out of the bank. So if the bank goes under, at least there's a fintech or somebody out there who has all the transaction information. Not only that, but what CFPB is also saying is that you cannot have black boxes making decisions for consumers. Right? You cannot have credit bureaus saying, okay, your FICO score is 730, yours is 620, yours is this, yours is that. For whatever reason, they're assigning you that score, and the consumer has no say on it, right? And has no visibility into what happened. Like, they'll give you some general guidelines in terms of, make sure you pay all your credit card statements, credit card balances every time, don't default, blah, blah, blah. But what CFPB is getting into that information as well. And also, in the US, the open banking went from screen scraping to APIs. So screen scraping had a lot of data available. APIs are cutting the data down to the use cases. So CFPB is making sure that the data that the fintech needs you get. So there's a lot to that regulation that is.
Yeah, it's an interesting market to look out for and see what benefits. Maybe some of our Indian fintechs, especially TSPs, can look for some opportunities there in the US markets. That brings me to the last question of today, Mr. Sarkar. We've been building DPI as public code for us in India, but how can we take this DPI? And I know there's some work which we've done on UPI and even other, let's say an AA in this case. How do we take something like this through some kind of a standardization format for a global markets, and if there is even a need to think about that?
Yeah, again, thank you very much. I think this, that's, if I may bring the G20 perspective a little bit.
Please.
So that, see, that's the whole purpose of having this G20 as a group. G20 today is the most premier group where essentially it is a forum where the financial issues and other issues, including this particular issues, can be discussed, and that exchange of information and showcasing and experience sharing with the intention to disseminate and whomsoever find it appropriate may use. So therefore, it would be a very interesting thing to keep on exchange of information and innovative methods. And that there are increasing interest among various countries that what are the innovative things and responsible things that is solving problems not once, not in good time, but also difficult time. So therefore, that has become a model, and then there is a lot of pull factor rather than push factor.
Right.
So therefore, it would be very good to have some kind of understanding and standardization in a sense that systems can talk each other, and interoperable and convergence that can ultimately help us running and reaching to the common goal of greater financial inclusion, greater growth, and finally development.
Perfect. I think that's a perfect note to end with. I know Bill and Anil also kind of agrees what we are trying to build here in India is unique, and it's very different to some of the other cases that are there globally. And this session was all about learning from each other. Thank you very much. I don't know whether we have time for questions because we've taken quite a lot of time, but if there is, maybe we can take one question if anybody has. Yes, please. Can somebody give him a mic, please? Maybe you can just speak, yeah, if you can. Yeah, you can you just pass on this mic?
Thank you, sir. Actually, my question is for Mr. Chanchal Sarkar. Clearly, sir, from the experience shared by the esteemed members of our panel, it's clear that India has taken a lead position in creating digital public infrastructure, at least for financial services for sure. Each one of the developed markets has faced various hurdles, as elaborated by Mr. Anil, Mahalaha, Dr. Bill Roberts. Do you think there lies an opportunity for us, given that we have already taken the lead in this space, to actually have this as an exportable item for
I think you did address it to some extent.
In the G10,
Can we
20
export
context,
this to?
is that a feasible option, given that you're anyways at a trans-country forum where that could be actually proposed? And do you think that's relevant?
Thank you very much. I think I did indicate in my last part of the last question and answer I made. See, it's not a question of export. We want to share our experience. We want to tell that this is a story, and we have benefited. And in 2008, we were one of the 20% level in terms of financial inclusion. And today, we are 80% within a span of 8 years. We have achieved various studies, including BI studies, have shown that in normal course, without DPI, India would have taken 47 years, which we have achieved in 8 years. So therefore, we do not need to export it. That's why I say that it's more of a pull factor rather than push factor. But India would very much like to contribute and share its experience, whichever way it is best suited for the recipient. We are ready, and we do not wish to export or impose. We want to work together.
You want to add something on Bill?
Yeah, I'll just add, there's a massive opportunity. There are at least 60 jurisdictions around the world now, either contemplating open banking or actually implementing it. Most of them aren't really sure what to do. We had endless delegations coming to visit at the CMA. Now I'm at Cambridge, all the same questions are being asked by these jurisdictions. And they don't want to hear it from academics. They want to hear it from the people who have actually built these systems. So there's a massive opportunity. I know you've got a big internal market in India, but it's a very, very big market out there in the rest of the world. 60 at least jurisdictions. It includes, including China. There's some quite big markets out there that you might be looking at from India.
If I may add
please.
one thing that which I forgot to mention, that there are already number of countries that have shown interest in various aspects of the DPI, for example, Morocco and mostly the Philippines, Sri Lanka, and some of the other countries. And even with Singapore, we have this payment arrangement. So there has been a lot of interest. So therefore, by that, if you interpret in that way, that if you want to say that can we export, we have already done. So then a lot of interests are there.
Yeah, so maybe on a lighter note, next year we'll call it Global SamvAAd, so that it's a global event than just an Indian event. There was another question, maybe very quickly we need to close.
So, good evening, sir. Thanks for giving us opportunity to access to the policymakers. My question is to Mr. Sarkar that we are talking about the financial inclusion. So we have opened, thanks to Jan Dhan program, now banks accounts are being opened to the lowest strata. Banks accounts are there. But where is the money? Okay. So actually they open the bank account, they can access to account aggregator. But what is the behavioral trends we can get into this account aggregator framework? What I meant is that, for example, if a neighborhood lender knows the trend, okay, Nina has given 3 months se paisa de rahi hai, so that's it. that kind of behavioral trends or digital capital, what Mr. Nandan, or say phone records, or say utility kind of thing, until that comes in the account aggregator, how we will be able to serve the lowest strata of the society in financial inclusion?
Yeah, I don't know if you want to answer something like this, but
No, I think this is quite relevant. I mean, what exactly does
what she's saying is that there is financial data today, but I think she wants more than financial data to make an opinion about the credit worthiness, right? So she's saying, is there something more AA can do in trying to get data beyond the financial data?
So that part, I keep my comment.
Right. I thought as much, because right now the architecture of AA is built on financial data, and all financial data of all 4 regulator is available. One thing that's been talked about of late is to try and get non-financial data to start with GST and tax data, but that's work in progress and we'll have to see how that works. But it's a suggestion that we'd like to take to SamvAAd and see what can be done there.
Thank you, sir.
Thank you so much. I think it's been a very, very interesting session. Thank you, Bill, Anil, Mr. Sarkar, for coming here and talking about global regulations, global insights, and how we here in India can utilize that. Thank you so much. Thank you.
Thank you so much to our panel. Firstly, to our moderator for so skillfully extracting these pearls of insight from our speakers, and then to the speakers themselves for sharing their points of view and experiences. I'd like to invite the co-founder of SamvAAd, Siddharth Shetty, to please come and facilitate our speakers with a small token of thanks.
No, sir. Please, please.
So folks, this concludes this track C of the SamvAAd event. The 2 other tracks are still continuing in the next rooms. So if you'd like to go join those, please go do so. Around 6 p.m., the events should be concluding, and we'll be having a mixer and refreshments outside once again. So one final time, round of applause for our speakers. Thank you all for being here.